Maybe you own Tesla stock, or maybe you are eyeing it and thinking of buying it. In the week after the US presidential elections, Tesla stock surged up by a massive 44% in just 7 days, taking its 6-month growth to over 88%, making investors wonder, is this the surge they have been waiting for over the last few years? But even with this massive growth and post-election high, Tesla is still trading at 18% below its high of 3 years ago. So which one is it? Is this the next rally, or is Tesla stock heavily overpriced and looking for the next opportunity to tank? In today's video, we're diving deep into one of the hottest stocks on the market, with all the buzz around Elon Musk, electric vehicles, and Tesla's future. The big question, is Tesla stock overpriced, or is there still room to grow? I'll break down everything you need to know, from the current price to key factors driving the stock, and whether or not it makes sense to buy right now, hold, or even sell your Tesla stocks before it goes back down. So let's get started. First, let's set the stage with where Tesla stock is right now. While I make this video, Tesla is trading at $332 per share. That's up a whopping 35% since the US presidential election earlier this month. For context, that's a pretty massive gain. Now, Tesla's stock price has historically been a roller coaster ride, but what's behind this spike? When you're analyzing a stock like Tesla, there are several big picture factors to consider. So, let's break them down. 1. Government influence and policy changes. This is partly due to investor optimism for potential policy changes under Donald Trump, which may favor electric vehicle manufacturers like Tesla. The fact that Elon Musk campaigned for Trump and then was appointed in a position of power to affect new policies and efficiencies under the new department DOGE, while it may pose moral questions, leaves people thinking he may be able to influence the very policies which would allow his own company to grow. However, on the other hand, Tesla's price has been dropping a bit recently due to announcements by Trump that he may look to cut EV credits and implement certain tariffs, both of which would negatively affect Tesla. But then, California has proposed state-level EV tax credits to offset any potential federal cuts. And while we're still waiting to see how things unfold at the national level, this creates a lot of optimism in the market. So it's a bit of up and down to see which policies stick, but overall, the fact Elon's president won and he's been appointed to a position of power in his administration has got their stock price buzzing. Also, am I the only one who finds that just a little bit odd? No, just me then. 2. Market sentiment. Is this a speculative surge? The second major factor is market sentiment. You might have heard the term animal spirits used by analysts to describe an excited or overly optimistic market. Well, that's exactly what some analysts believe is happening right now with Tesla. UBS, for example, has pointed out that the recent surge might not be entirely based on fundamentals, but more on speculation and market hype. It's not unusual for growth stocks to get caught up in this type of excitement, and while Tesla's technology and vision have made it a household name, we need to consider whether the stock price is truly reflecting its current fundamentals, or if it's riding a wave of market enthusiasm. So let's figure that out. Let's talk about Tesla's financials. But before we get there, if you want to get some ideas of which stocks to buy for your portfolio, or if you want to follow my own $13,000 portfolio that has a $1,000 a year dividend income, then you might want to check out the Casual Cash Club. That is where I post every single stock that I buy and sell in real time to build my portfolio. And I'll also break down certain stocks which I think are good buys for myself. And to show that, I've been doing an experiment where I've been starting to track every time I mention a stock in the Casual Cash Club, and if you were to have invested just $10 in each stock mentioned. I'm going through 3 years of posts, but so far, if you had invested $10 in each share when it was mentioned in the club, you would have a portfolio that is up by a total return of 57.62% right now and a dividend income of 8.89%. I also give updates of my portfolio and dividend income every month, and best of all, this December I'm giving a 90% discount to any new members. I wanted to do 100%, but Patreon didn't let me. Either way, that means it's just 50 cents or 9 Rand this December. And with that, you get access to all the historical posts. So go to the link in the description and I'll see you in the Casual Cash Club. Now, in terms of earnings, Tesla's forecast for the next quarter is expected to be around 77 cents per share, which gives it a pretty high price to earnings ratio, which we'll get to. While this isn't a huge profit by some standards, Tesla is investing heavily in future growth, and a lot of analysts believe their earnings will rise in the coming years, especially as they ramp up production of vehicles and energy products like solar panels and batteries. The company has also been scaling its global operations with massive factories in places like Berlin and Shanghai and a new one under construction in Mexico. Tesla is expanding its production capacity to meet increasing demand. This could set the stage for future profitability, but it's a big bet on growth. If production ramps up and demand remains strong, Tesla's profits could rise. But if demand slows or production faces setbacks, the stock could take a hit. Because just before the election, Tesla's share price had been declining based on slowing sales and the speculation that they were starting to reach market saturation, meaning the people who wanted a Tesla already have a Tesla, and other market competitors were starting to gain more market share. Some analysts are clearly concerned about overvaluation. Morningstar, for example, estimates Tesla's fair value at around $210 per share. That's a 57% discount to its current price. They believe that Tesla's market cap, which is over $1 trillion, is not yet justified by the company's earnings or revenue. On the other hand, some analysts see potential for higher prices. Tesla's future expansion plans and market dominance in the EV sector could make its current valuation seem more reasonable over time. But the average 12-month price target for Tesla, according to 34 analysts, is about $228, which implies a potential 32% drop from its current price. That's quite a significant gap. Now, let's talk about the competition. Tesla has been the dominant player in the electrical vehicle market, but there are some strong competitors emerging. Rivian, BYD, and Lucid Motors, all backed by major investments and partnerships, are working hard to challenge Tesla's position. But it's not just startups. Traditional automakers are all in on electric vehicles too. Companies like Ford, General Motors, and VW are ramping up their EV production, making it clear that Tesla isn't the only player in town anymore. So, the question for investors is, how will Tesla maintain its leadership position? Will it be a MySpace or a Facebook, a BlackBerry or an iPhone? If they can continue to outpace the competitors with innovation and scaling, Tesla's stock could keep climbing. But if rivals catch up or surpass Tesla, the stock could struggle. The typical way that you tell if a stock is priced well is its price to earnings ratio, or PE ratio. It's basically the price of the share divided by its earnings. And the higher the number shows how expensive it is to buy each dollar of earnings. So higher number equals more expensive and potentially overpriced stock. So Rivian and Lucid have a negative PE ratio of under -2, which means they have negative earnings while they invest in and grow their infrastructure. This was the same for Tesla, as it lost money for 15 years before its first annual profit in 2020. Then you have the larger traditional car makers, with Ford at 12, General Motors at around 6, and then VW with a PE ratio of 3. So all reasonably priced stocks compared to its earnings. But if we look at Tesla, it has a PE ratio of 91, so about 30 times the PE ratio of VW. Now, of course, there is a reason for that. Although the earnings currently do not support the price on a fundamental basis, many people view Tesla as the next Apple and are willing to pay a premium to own that stock now. But the question is, how much is too much? For me, I think any stock that jumps 44% in 7 days because of a new president is probably based on hype more than solid estimated sales growth. And even with the recent mania, the stock is still 18% below what it was 3 years ago. So personally, I think most people can see the price is overinflated right now. But what it comes down to at the end of the day is whether you personally think Tesla will live up to what people think it could be, or if you think reality will catch up to the hype and it won't be as rosy as the market thinks it will be. Either way, it's up to you to decide. All I will do is remind you not to put all your eggs in any one basket and ensure you have a diversified portfolio spread across many companies, ETFs, and industries. I don't think it's a good idea to bet the house on any one stock, especially one this volatile. As for me, I have a very small holding in Tesla, which is up 39%, and I'm just going to leave it like that. I'm not going to buy right now. I'm not going to sell. I'm just going to hold it and see where it goes. I'll keep investing and growing all of the different holdings in my portfolio to make sure that I have a piece of each pie, but I'm not tying my success or failure to any one piece of any one pie. And guys, that is it for today's video. I hope you enjoyed it, and please subscribe to see more videos like this. And if you want to follow my own portfolio and get some ideas of possible stocks based on what I bought, you can claim your 90% off for the Casual Cash Club with the link in the description. But until then, I'll see you guys next time, as always, on Casual Cash. Cheers.